Welcome to the Property Buyble. This show was created for current property owners, people looking to purchase property, and for professionals in the industry. Hope you enjoy. Welcome back to the Property Buyble. My name's Kim Ackerman. I'm a buyer's agent from Trelease Associates in Sydney. If you watched last episode or listened to last episode, we talked a lot about how to buy property without cash or without a deposit saved up. Today is going to be part 2 of that series, and we're going to be talking about using equity as well as cross-collateralisation. That is a large word. We're still debating as to how to say it, but I'm going to be using cross-collateralisation today. Today I have with me again, joining us, Joseph Daoud from It's Simple Finance.
Thanks for having me back, Kim.
You're very welcome. It's good to have you back. This is another big chunk of this topic, so I want to go into detail a little bit further and talk about a second way in which people can buy property or get into the property market. However, if they don't have any savings or anything like that, this is another method in which to do so.
Yeah.
So I guess before we start talking about this topic, I should probably start by saying this method is for people who already have existing property in place.
Yes.
In order to use equity, you have to pull equity from somewhere. And so most of the time that is pulled from a property that is already pre-existing on your portfolio, for example. You only need one. So that I really wanted to start by saying that at the beginning of this topic, because you're not going to be able to use equity to buy the next property unless you already have existing equity.
Yeah. So tapping into equity is really used for people who are asset rich and like to diversify their portfolio rather than keeping all their cash saved in a bank and basically build their wealth. We see people tap into equity, by using their own occupied property and then, basically building up, equity by either paying their loan down or, having the property increase in value.
Yeah.
And then they just basically draw down from that property to go purchase their second investment or to go purchase another holiday home or something along the lines of that.
Yeah.
So it's really for the people who have purchased their first property, have held that for a couple of years, have seen a steady incline in, appreciation, and then drawing down on those funds.
Of course. And for anyone listening who isn't aware or doesn't know what equity is, because it's quite a big word that's thrown around, we did do an episode on the Property Buyble a few weeks ago on what is equity and how to maximize it. So if you're listening to this episode and you haven't heard that first and you want to know a bit about it, it'd be great to use that as a prerequisite before you listen to this episode, to give you a bit of a background of how to build equity first, and then we can get into this episode on how to use it to buy your next property. So I guess we should start by giving people an example of how we can use this equity and then drill down into the different types of equity and what cross-collateralisation is and everything in between. So if we were to have an existing property, just say I was to own one property in my portfolio and now it comes time for me to buy that next one, could you give us an example of how that would sort of work?
I'll give you a great example. Okay. So let's say, for instance, you purchased your property 5 years ago and it was worth $500,000. Okay.
Yep.
At the time, you had a 20% deposit. So your loan was worth $400,000.
Yep.
In that time, you have been paying down your mortgage steadily over the last 5 years, but also your property has increased in value. So it was initially worth $500,000. You've gotten it revalued. It's now worth $600,000.
Yep.
But you've also paid down that loan to, let's say, $360,000 or something along the lines of that. You can then draw up that equity up to 80% to $480,000. So that gap between $360,000 to $480,000 is now usable equity.
Yep.
Okay. So you've got $120,000 to play with. Okay. So a great way to think about this is, okay, I've purchased one property for $500,000. I've got now another $120,000 that I can use in usable equity. Well, $100,000 of that can go towards the deposit. The other $20,000 can go towards the stamp duty.
Yeah.
And then we've got another investment property and we've built our portfolio.
Yeah,
exactly. So tapping into equity is the process of refinancing and finding that usable cash within your property to be able to grow your portfolio.
Okay. And that's a good runoff from our last episode that we did on using a guarantor. So, using their equity to buy your next property. Now we're using our equity to buy the next property. So there's two different ways we can do that we've been talking about. There's using, the pure equity from your property. And then there's also, and using that equity to be able to put that onto another property, physically, put that money onto another property. And then the other thing is cross-collateralisation. So could you please let people know, I guess, the difference between the two?
Well, when we're using a cash out, we're essentially keeping the properties separate.
Okay.
We're not combining the two properties and putting them under one loan. So if I'm using property A and I'm drawing down 20% cash from that to purchase another property, those two properties are separate. How this differs from cross-collateralisation is when you're using a cash out, it's not always necessarily for a property. To purchase another property, you can have a cash out for renovations. You can have a cash out to be able to use that cash for, investing in stocks, the share market, something along the lines of that. Or you can use it to purchase another property.
So you're separating the money. Right. So you're pulling out the money from one property and then you're using it as cash. That's why we call it cash out for this new property, for its deposit, stamp duty or whatever.
That is correct. But then when you cross-collateralize, you're never actually physically getting that money. Okay. There's not a separate bank account being created for that cash to be utilized. It's basically telling the bank, hey, I've made one purchase here. I've got my property here. I want to use the equity between the both to drop my LVR, my loan to value ratio, underneath that 80%. And then that way I can either repurpose the debt or I could just have one home loan to make things simple for myself and just continuously pay that off.
And I think, when we talk about the word cross-collateralisation, it's a very large word. And it's a very confusing thing for some people. So I guess a good way to explain that would be, imagine both of those properties were combined into one pool. So rather than having 80% LVR in one and 80% of LVR in the other, you now have just one big loan. Those two properties are linked and you're using the equity in one of them towards the margin of that 20% deposit in the other one.
Are you sure you weren't a mortgage broker in a former life?
Possibly. I've had a lot of mortgages in my life. So it's really good to explain this to people, especially when they're buying only their first or second property. Most people don't know what LVR is, certainly don't know what cross-collateralisation is and equity and how to use that to their advantage. I always say to people, forget about what's normal. Let's look at what's possible and merge those things together and then maximize your financial position,
of course,
going forward. Now, I always need to say this, and we talked about this before, everybody is different. Everyone's financial situation is different. So before you choose which path is best for you, it's good to have a chat with your mortgage broker. It's good to have a chat with your accountant, financial planner, anybody else involved in your long-term plans to see which option is best for you, because there's so many different rules that we're not necessarily going to go into today. I also want to touch on the fact that with the cash out option, so we're talking about cash out refinancing, cross-collateralisation refinancing. They're the two that we're really going through today. With the cash out option, I do know back, 10 years ago when I had one of my first properties and I gained equity from capital improvements and also just the general capital value going up. That equity I could just pull out at any point in time. Was very, very easy. My broker at the time would refinance my mortgage, up the mortgage to a larger amount, and I could literally do whatever I wanted with that cash. Now, not so easy anymore. Are you finding that every year is kind of getting a little bit harder with things like that?
Since about 3 years ago in particular, we've had to see, I wouldn't say that it's harder, but because we do want to make sure the money is going to the right spot. But
so they're not going to the casino, for example.
That's it. So with the cash outs 10 years ago, you were able to, draw down the equity and just basically go
do whatever the hell you want.
Do whatever you wanted. You didn't. It was just a verbal reasoning. It wasn't even written in paper. It wasn't an accountant's letter, anything along the lines of that. I think the tighter restrictions are a good thing.
Yeah.
Because we're not having people go into these massive debts and, just spend their money on, whatever.
Nothing.
Now we have to get an accountant's letter. We have to get a declaration. We have to, be able to see builders contracts. We have to see if they're purchasing a pool or they're getting a pool built. We have to ensure that, there's a contract on the way. So I don't think that it's a bad idea.
Yeah.
But also it's a good thing to know which lender you can go to and who will ask for the most documentation.
Yeah.
So for example, Macquarie Bank will do up to 80% cash out, on cosmetic renovations.
Okay.
And they won't necessarily need the builder's contracts or anything along the lines of that.
So what kind of proof do they ask for?
They will usually ask for, photos after or a revaluation after or something along the lines of
Afterwards.
that. Yep. And they do ask for some builder's contracts. Okay. But they just want to make sure that, you are using the money for the right causes.
Yeah.
Okay. But then a bank like St. George will ask for everything, up front. They'll go, hey, this is what we need here. This is what we need there. And a lot of the time, even if you have all the proof, they'll still reject your application.
Yeah, right.
Because they don't want to lend money to people to do the wrong thing.
Yeah. And I guess increase it to a level where they can't afford to repay that back.
Yeah.
So you've got a service for these bigger loans, regardless, obviously. Just because you have equity in your property, it doesn't mean that you can pull it out. You've got to be able to service the new higher loan. You've got to be able to repay the repayments each month, so on and so forth. But I really just wanted to touch on that because I've certainly been in situations before where I've wanted to pull out my equity and I haven't really been sure on what I'm going to buy yet, but I wanted to set everything up so that the money was there sitting in my offset account should I be ready to buy the next thing.
And that is definitely a great way to get your deposit ready.
Yeah.
So let's say I'm going to auction on Saturday and I want to make a bid and I don't have cash.
Yeah.
I put my hand up and I've got to sign a check over.
Yeah.
Who's going to get stuffed?
Yeah.
Everyone.
Exactly.
In the process. But if I go and get the cash out and I let the bank know, hey, this is going to be a deposit for a future investment property.
Yes.
You have to make sure you're going to the right lender first. Okay. But if you do go to the right lender, you can have that money sitting in the offset and bang, you can purchase your property right then and there.
I've actually been in situations before where the banks have said, show us the contract of the new property you're buying. And I'm like, whoa, I don't even know where I'm going to buy yet. I just want to get this money ready for the next one.
Yeah.
So every situation is different. Obviously, a broker or a lending specialist like yourself is going to be able to coordinate all of that for somebody so that they don't feel overwhelmed with the timing of all of these things as well. But the cash out is definitely a big thing. With the cross-collateralization or collateralization, you do have those two properties linked.
Yep.
And that's something that I've spoken about before on the Property Buyble. When your properties are linked, you just have to be very careful and keep it in the back of your mind. If something was to happen and you can no longer afford to pay for one of those properties and they're still sort of maxed out to the eyeballs, you have to be very careful because you can't just sell one off. They're both linked now. And therefore, you have to pay them both down to a reasonable amount, normally that 80% LVR mark. Otherwise, you end up paying LMI. You've got to get refinancing, pay extra fees. You might have to pay break fees. There's all these other things to consider.
Yeah.
So it's really important and people understand what is cross-collateralization.
Yeah.
And I guess that leads us to the next thing, the pros and cons of each of them. So what would you say are some advantages and disadvantages of the cash out option?
So the biggest advantage is obviously keeping the property separate.
Yeah.
Okay. I've got one loan. This is my owner occupied property.
Yeah.
That's just going to get paid down. Yes, I've got a portion of debt on that towards my investment property, but the main loan is just my owner occ.
Yeah.
Then I've got my investment property that is completely separate. So when I go to sell my investment property, I don't have to go get my owner occupied property revalued. I don't have to, go through that whole arduous process of refinancing and creating a whole new loan again. I've got my investment property. Yes, I might be paying
It's clean cut.
It's clean cut.
Yeah.
Done. Sold.
Yeah.
I'm finished with it.
Yeah.
That's the biggest advantage.
Yes.
A disadvantage though, and where we see an advantage with cross-collateralization is if I had those two properties linked together, I would be able to repurpose a lot of my debt. And this isn't tax advice or anything like that.
No.
But I'd be able to repurpose a lot of my debt onto my investment property, and that might be a tax advantage for myself.
Right.
Another advantage of getting the cash out is having the cash ready if I want to go to auction, or having the cash ready if I want to be able to purchase a property right then and there on the spot. I don't want to be waiting a 7 or 8 week approval time to be able to go make that purchase. I want to be able to go do it as fast as possible.
Yeah.
You know, you can miss on properties, and I've seen it before. I've seen areas where there are bargains up, okay? They're off market, but they need, you know, a deposit right then and there on the spot, and the purchaser isn't ready.
Yeah.
They call me up, hey Joe, I need to cash out as soon as possible. Fantastic. Okay.
Yeah.
You know, I'm going to try and do my best, but we can't always perform miracles, and that's just the way that it is.
I know. And back to the tax implications, things that you just mentioned, because we have talked about this before. And again, this is not specific tax advice. This is just very
Speak
general.
to an accountant.
It's very general information to give to people. When you pull out equity from your owner-occupier home loan, for example, and you use that money or that cash out towards an investor or an investment property, you have to be able to tell your accountant where that money is being moved around, so that those little dollars, which I like to call little soldiers that work for you, those soldiers are now investment soldiers.
Yep.
That's how I like to explain it. So you want to make every dollar work for you, right? You don't want to put it in a savings account because they're just going to sit there and bludge all day. You want to make those little soldiers work for you by investing them in different pockets and different things. That's weird, but that's how I like to explain things.
That's the best analogy I've ever heard.
So these little soldiers that have been taken from your owner-occupier home loan, your home loan is not tax deductible. The interest on your home loan is not tax deductible. Any strata rates, council rates, water rates, they're not tax deductible. That's why a lot of people or a lot of tax accountants say, pay down your home loan as much as you can, or use the equity from an investment property, dump it onto the debt of your home loan, because that part, if you're watching the YouTube video, you can see me using my hands a lot right now to explain things, but that part is going to be, you know, dropping down the debt. You want all of the debt to be in the investment because that's the part that's tax deductible.
That's correct.
Where am I getting at with this? I think the thing that I'm getting at is that when you start cross-collateralizing and you start using cash out for equity, you have to be able to tell your accountant where you're putting that money, so that come tax time, they can see where everything's been moved around. And if debt is in one place versus another place, it can get very confusing.
That's correct.
So like you were saying with
That's
the cash out.
That's why we always say, speak to a tax accountant.
Speak to a tax accountant.
Before you go and make a decision on which lending structure is best for you.
Yes, because it's not as easy as all the debt's in one place, but you actually got that money from another place.
Yeah.
So you have to be able to explain that, especially when it comes time to selling, capital gains tax and all that sort of stuff can get very, very confusing. So I think, you know, in a roundabout way, I wanted to touch on that today so that people understand it's not as easy as just pulling money out from one place and dumping it in another place. And with the cross-collateralization, it can get very, very complex because you're mixing those soldiers together. So to say. So that's another point I wanted to make. And I guess for the steps for us to do this, if I am somebody that has a bunch of equity and I want to go buy property too, what's the first thing that I should look at doing?
Look, you can either contact a private valuer or you speak to a lending specialist, so then they can contact a valuer for you. The reason for that is you don't want to say, yeah, I've got all this usable equity, I'm just going to go make a purchase, and then find out your property's, you know, got no equity in it. And you've got this massive deposit that you could be, you know, up for.
For sure.
So we want to avoid that risk. Okay. We want to make sure that we do this correctly. So it's always beauty in the eyes of the beholder. Okay. So if you have the valuer come out and they tell you your property is worth, you know, 20%, 30% more than what you initially purchased it for.
So that's really step one. Getting a valuation on your property. We want to know how much money are we working with here. And there's no point in looking up values online or looking at comparable sales in the street. The only way you're going to get a set dollar figure is by, watch the table, is by really getting a proper valuation, a formal valuation done by the bank or by the lender.
You can't always go off REA or domain.com.au. And the reason for that is the way that valuations are done is they're done with the thought of 90-day rapid sale in mind.
Yeah.
So if you ever default on your home loan, the bank can automatically sell that home in 90 days, as opposed to what the market value is, because we've seen properties before sit on the market for 6-7 months, okay, because the seller doesn't want to drop their price down or anything like that. That's not a valid indication. So that's why valuations can be conservative sometimes.
Yes.
And that's why it's a good idea. Step one, go get your property valued. So after you've started the valuation process, or you have an indicative value of what your property is worth, the next is beginning the refinancing process and basically getting that cash out.
Yes.
And selecting a lender that will give you the highest maximum value on your property. So then when you do get the cash out, you're able to go purchase the investment, or able to go purchase the second property that you do desire.
Yeah.
Something that I know you want to touch on is go shop at multiple lenders, because everyone has a different valuation policy. Now, NAB might have, and I'm just going to use a suburb like Bondi, for example. Okay. NAB has a certain square meter rate of what they think properties in Bondi are valued at.
Love that.
But then a bank like St. George might have a completely separate square meter rate. So you might have two valuations done by the same bank, not the same bank, by the same company.
Yeah.
Okay. But because the valuations are going to two different banks, there could be a huge discrepancy between what one bank thinks your property is valued at, what another bank thinks it's valued at. We've seen $50,000 to $75,000 valuation differences, and that's huge.
That's huge.
Yeah.
Yeah. Wow.
And especially when you're tapping into equity. So it's, something that you definitely need to look at.
And when you say the same company, I think a lot of people don't realize if you have a valuation done, if a bank does a valuation for a client or a potential client or customer, one bank will use a certain valuer, and they're usually external valuers. Not the bank is valuing. They hire like a subcontractor to come and value for their property. But Macquarie and NAB might hire the same valuer.
Yeah.
But the difference is they both have different policies. So they're going to come back with different outcomes, which is weird and crazy. And you think it doesn't really make sense, but they have their own policies and procedures internally, and they have reasons for that. So it's good to shop around. Doesn't usually cost anything to shop around, but it's going to end up making you a lot more money in the long term.
That is exactly right.
Yeah.
My best advice to anyone that's looking to grow their investment portfolio is don't rush. Okay. Make sure you speak to the right people.
Yeah.
And then they will put you in the best situation.
Yeah, for sure.
Yeah.
Okay. We could talk all day about this. We really need to give people some tips on what they can do to buy property without having a saved up deposit for, deposit or stamp duty, without having any saved up cash, by using equity or cross-collateralizing.
It's literally my favorite topic. I could sit here for 12 hours on end, but
it's good. It's good. There's lots of stuff there to go into, and I think we've provided people with a lot of tools to use when they're out there. But just to touch on a couple of things as far as tips are concerned, speak to your accountant, financial broker, and speak to a lending specialist or broker that knows what they're doing and knows how to be creative with this information, best suited for you.
So the second tip that I do want to mention is if you're on a fixed or a variable loan. Now,
for your existing loan.
Yeah. Now, a lot of people are often cautious because if they're on a fixed loan, they are under the assumption that I'm going to incur a lot of break fees. I'm going to incur a lot of break costs.
To pull out that equity.
And that is true most of the time, but it isn't always the case.
So you have an example of something that happened recently where you found sort of a loophole, I guess you'd say, of how you had a client that was in a fixed rate and thought, I can't pull out any equity from this property. I can't refinance because I'm on a fixed rate for the next 4 years. But you actually found a way to get out of that. Is that right?
Yeah. Now, it's not a loophole. This is completely legal. This is, just by law how the banks are supposed to act.
Yes.
So let's say I refinanced my loan a couple months ago with NAB, and I was refinanced to a 1.98% 4-year fixed rate.
Yep.
Now, most people think if I want to leave a fixed rate mortgage, I'm going to incur the break costs.
Yep.
That's not how it works. So NAB has recently increased their 4-year fixed rate to 2.08%.
Gotcha.
Okay. Now, because I want to refinance and leave. My break cost isn't calculated on the 4 years. It's calculated on the difference between the rate that I'm on and the rate that's currently being advertised. So that 1.98 is now being advertised at 2.08.
Yep.
So the bank actually doesn't like me as a customer.
Yeah.
Because
you're on the lower rate.
I'm on the lower rate. They want to have people on a 4-year fix at 2.08%. Okay. So when this customer then asked for his break cost, he wasn't up for thousands and thousands of dollars in fees. They said, your break fee is $0. You're free to refinance.
Because it was actually more at this point in time.
That is correct. If anything, the bank owed him money.
Okay. Yeah. Interesting. So it's done the opposite to what people think it's going to do, which doesn't always happen.
Yep.
But it is a different perspective to look at. So don't always assume, which is something that I've learned this week as well. I've always assumed if you're in a fixed rate and you want to break that fixed rate and refinance your property, that you're going to be up for some sort of costs. It's just not the case. Get a lending specialist to take a look at your situation.
That's exactly right.
I think there's just 3 more tips that I want to, quickly touch on. One of them is understand the risks associated with both of those options, whether you're pulling cash out or you're cross-collateralizing your properties. We touched on that a bit during this episode, and people can go out and do their own research on that and speak to professionals in their team to find out what that means for them and their personal situation. Understand if you exceed your 80% LVR on your current existing loan, you may be up for some LMI costs.
Correct. Yep.
And you have to make sure if you are up for those LMI costs in comparison to the goals you're trying to achieve, is it worth me going down this road, or is it worth me waiting a little bit longer to have the value of my original property go up so that I'm not paying LMI costs. So that's another thing to think about. Understand, next tip is understand that this is a 2-step process. We've got your first property, we need to refinance, pull out that equity, or cross-collateralize, pull out that equity, and then be able to use that for the second loan. So you always have to get a second loan for the new property. People just think, oh, okay, I'm going to refinance and I'm going to be ready. No, you've got to get pre-approved for that second loan to be able to go out there and actually buy something. This first step is just setting you up, similar to how you would normally save a deposit. It's the same sort of thing.
Yeah, that's for sure. You want to make sure that if you are going for that second property, that you've got a fully assessed pre-approval.
Yes.
So that you don't just have a computer generated one.
Yes.
And when it comes time for you to move to formal approval and book in your settlement, you're not hit with any surprises.
Yeah. A lot of people, especially buyers that come to Trelease, they'll say, oh, it's fine. I've spoken to my broker. Like I definitely can borrow that much. And we sort of say, well, that's great. I'm sure it's fine. However, it's important that you have a formal pre-approval and it's a formal assessment before we start your search process, because anything can change. Someone can assume something and then maybe they don't get that pre-approval in place, and we don't want that to happen. So like Joey said, make sure that you have a fully assessed pre-approval in place before you start shopping. Don't window shop, people. I guarantee you will find something that you like. You'll want to buy it and you won't be ready to, and you'll get really upset that you missed out. Happens all the time. But anyway, that is a wrap. That is everything. There's so much more to this, and we've got some other episodes coming up talking about other ways to buy property without having that cash saved up. But thank you for your time.
Thanks so much for having me again.
As always. I hope this has provided people with, that second way to buy property without having any cash saved up, especially if they've already got property in their portfolio. So good luck as usual. Reach out to a buyer's agent if you're ever struggling with the buying process, and just know that there are other ways than the norm to purchase property, and it's good to be aware of that. And if you do want to check your borrowing capacity or what your future mortgage repayments and everything will be, our new website is now live, so www.itsimple.com.au, and you'll be able to calculate your stamp duty, calculate your maximum borrowing capacity, and actually see which lenders do prefer you and how much they're willing to lend you at their particular rates. Amazing. Okay. Fantastic. Well, thank you. Good luck out there. Thanks for tuning in, and we'll catch you next time.